Good morning, ma.
Good
Good
morning,
morning.
Good
ma'am.
morning.
Happy weekend to you all. Soon to be ACAs. I greet you specially. Thank you, Mr. Taiwo, for this opportunity. And please, if I am too fast, you can call my attention. If you have a question, you can signify by raising up your hand. The goal is for everyone to understand and be able to know what to put in your answer booklet when you see questions around this topic. Like he said earlier, my name is Obona Mercy Nena. You can call me Nena, you can call me Mercy, you can call me Mercy, please. Whichever one is good for you, that is fine, right? So, sir, have you started the recording?
Yes, ma'am.
Okay, so today we'll be talking about introduction to strategic financial management. And this is a testable topic in SFM. And from this topic, you can get your free 15 to 20 marks without stress. That is if you understand the topic and you're able to put it down in the way the examiner wants. So we'll start by defining what strategy is. Now, before we go into the technical definitions of strategy, there's something I want you to think about. There's a simple example I want to give to you. Now, let's assume you have qualified and you are called for induction. You will not just wake up one morning, carry your bag and say, I'm going to Lagos for my induction. Now, there are plans you need to make. You don't just, move out. You need to buy your outfit. You need to determine, when am I going? The induction is on a Tuesday and on a Wednesday. Do I go on Saturday? Do I have friends to stay with? What routes am I taking? Do I travel by road? Do I travel by air? Now, if I'm traveling by road and then maybe along the road, the bus has an issue, do I have enough time to wait for them to fix that bus? Or do I need to go along with some cash in case that bus has an issue? I can easily join another bus. So these are the plans you make in order for you to achieve that thing you intend to achieve, that is attending your induction and not be left aside. So this is a simple sense of what strategy is all about. Strategy is not just about having a goal, right? It is about deciding where and how an organization wants to go about it, how they intend to get there, what resources, please mute yourself, what resources it will require, and how it will respond to changes in the environment. So this is why strategy is important in strategic financial management. As finance professionals, we are not only concerned with just recording figures, recording what has happened, how do you spend that money. That's not what we are just concerned about. We also have a role to play in helping organizations decide what should happen next, how resources should be deployed, and how value can be created and sustained. So we are going to look at different scholars that have looked at strategy from different perspectives. Now, Chandler says that strategy is the determination of the basic long-term goals, the objectives of an enterprise, and the adoption of courses of action and the allocation of resources necessary for carrying out these goals. It's an adoption of courses of action. You have to adopt. What do we want to achieve in the long term, right? Now, how are we going to carry it out? What resources do we need to carry out this goal? This is the definition of Chandler. Then we have Drucker. He said that strategy is a pattern of activities that seek to achieve the objectives of the organization and adapt its scopes, resources, and operations to environmental changes in the long term. We also move to Johnson, Scholes, and Whittington. I can like this man very well. If peradventure they want to say define according to which it's read, they don't normally do that. Is this person they will always say define according to, but they don't do that. They don't say according to, they just ask you a general question to know what you understand in that concept. And he says that strategy is the direction and scope of an organization over the long term, which achieves advantage in a changing environment through its configuration of resources and competencies with the aim of fulfilling the stakeholders' expectations. Now, so if we put all these definitions together, we can simply identify that there are 4 key things in this. Where are we now? Where do we want to go? How do we want to get there? And what resources and capabilities do we need to succeed? I hope we are following. So as we proceed in this topic, I want you to keep these 4 questions in your mind, right? Where are we now? Where do we want to go? How do we want to get there? And what resources and capabilities do we need to succeed? So from the course, you have strategic financial management, you have strategy, we have financial management, and then we have strategic financial management. So in simple terms, a strategy consists of organized activities, and the purpose of these activities is to achieve an objective, to achieve a goal. That's the purpose of these activities. So every organization have a set goal that they intend to achieve. And so they need set of organized activities, which is a strategy. How do we get there? How do I do it? Just like you're preparing for your ICANN exam, your attending lecture is a strategy to achieving the goal of becoming an ACA. Now, attending lectures alone is not enough strategy. You still have to do your self-study, you still have to solve questions. So these are a group of organized activities that will help you to achieve that goal of being an ACA. I hope I am communicating. So let's move to, having seen the meaning of strategy, let's move to financial management. So now that we have understood what strategy means, let's bring it into the financial aspects of an organization. Financial management is an aspect of strategic management that deals with planning and controlling of the financial affairs of an organization. Now, look at a picture of an organization. We have the CEO, that's the Chief Executive Director. We have the COO, Chief Operating Officer, those in charge of the operations. Now, those in the IT department, you call their manager a Chief Technical Officer. The accounts department will have Chief Financial Officer. The sales department will have Chief Sales Officer, things like that. Now, we are talking about the role of the accounts department now, which is the Chief Finance Officer. Right, so they are there, the accounts department or the financial department, finance department, whatever the organization calls it, are there to deal with the planning and controlling of the financial affairs of the organization, to ensure that the objective, especially financial objective, right? Now we have financial objective, we have non-financial objective, we'll get to that. So they are there to ensure that the financial objective of the organization is what is achieved. So in simple terms, financial management is about how an organization obtains their funds, money, how they generate funds, how they use the funds, and how they control the fund to achieve its objective. One thing is getting fund. Another thing is, how do we invest it, right? What do we do to this fund so that we will not lose out on this fund? This fund can generate more fund. This fund can help us to increase our profit, our revenue. What do we do? What kind of business do we invest in? These are the aspects of strategic financial management that the financial department handles. So it involves raising funds, investing funds, dividend decision, cash management, and risk management. Now, raising fund, it could be through shares, selling of more shares. The organization needs more money. Of course, money is never enough. The organization needs more money to operate and grow. So the financial manager must determine where the funds will come from. Where is it going to come from? Do we use equity? Is it loans? Do we collect loan? Of course, they should also determine if we are to go for loans. Though you go for loans, you have more money, but the more you ask for loans, of course, there's an advantage because the interest on the repayment of that loan is an allowable deduction for tax purposes. I know we know that. Now, aside thinking about the advantage, what about the disadvantage? If a company is highly geared, you know what that means. The market, the share price of that company will drop. I hope we are following. These are things we already know because I know you have gone far in that. Now, they could also think, how do we generate for? Is it through other sources of finance? Is it through what do we have left, our retained earnings? What do we have at hand? Should we continue from there or should we seek for external sources? So these are the decisions they make when it comes to raising of funds. Now, the question will now be, how do we get the money we need? Now, when they have gotten the money they need, they will now ask themselves, should the company buy new equipment with the money? Should we expand into another location? Should we invest in a new project? Should we acquire another business? That's where acquisition comes in. Abi, should we merge? That's merger. These are the things they think about. So that this will not help them to know which one should we go for. The question here will not be, where will our money generate the best return? If we buy new equipment to carry on our business, is it going to give us the best return, or we should expand into another location? Of course, you know that expanding your business into a new location, there are so many things you need to consider because it's a new location. We'll get to that in some other classes. Then we have here the dividend decision, where a company makes a profit. Then the management has to decide what to do with the profits. What should we do? Should we pay our shareholders as dividends? Should we retain it in the business? Or should we pay some and keep some? Should we partly pay out and then partly retain? What percentage should be given out and what percentage should we retain? Now, for cash management, a profitable organization can still fail if it does not have enough cash to meet its obligation. There is a way they will even have a surplus cash. If they are not able to invest that surplus cash, the business will not still profit them, right? Because they are holding on to much cash. And then if they don't also have cash to meet their obligations, it will still be a big problem to them. This is where cash management comes in, and it's only the financial managers that knows how to plan in order to ensure that the company does not run out of cash and the company does not have surplus cash, that they are not doing anything, just be lying idle in the business. So therefore, the financial management also involves and ensure that the organization has sufficient cash to either pay salaries, suppliers, pay their tax, pay back loans and other obligations as they may fall due. Then the last one there is risk management. Of course, we know that every financial decision carries some level of risk, right? For those of us that were there, were in skill level when there was CSME, corporate strategic, whatever. For those of us that passed through that class, of course, there's still risk in SFM because some of those courses were put in SFM, some of those topics. So you see that there are different kinds of risk that an organization can face. So every financial decision carries a level of risk. It could be credit risk, it could be interest repayment risk, it could be, there's so many of them. Right. So, for example, borrowing money creates interest and repayment obligation. So, investing in a new business or in a new project may result in loss if the project fails. So, this is a risk, right? You want to invest. This project, we have checked it, is profitable, it's going to yield good returns. But along the line, something may happen and then the company may lose a huge amount of money on that project because the project has failed on what they intended to achieve from it. So therefore, the organization must always do what? Identify, assess, and manage financial risk. This is what financial management is all about. Now that we have known what financial management is all about, so what then is strategic financial management? I know that some persons here now, your mind may be like, if financial management already deals with planning and controlling finances, then what makes strategic? Why do we now have to define strategic again? What makes it a strategic decision? Now, this is an excellent question, of course. Strategic financial management refers to the process of managing an organization's finance to achieve its overall corporate strategic objectives and goals. Underline the word, the process of managing an organization's finance to achieve overall corporate strategic objectives and goals. Now, it involves planning, organizing, and controlling financial resources to maximize shareholder value and achieve sustainable growth. Now, the key difference here is that in the long-term strategic perspective, financial management asks, how do we manage our finances effectively? While the strategic financial management asks, how do we manage our finances in a way that help us to achieve the long-term strategic objectives? Financial management will say, how do we manage our finances effectively? They are just after managing finances effectively, whether it's short-term, long-term, that what they know is, as at now, as at this month, what's our budget for this month? We have made our budget, our expenses is not supposed to exceed 25% of revenue. So we need to work on that. This is financial management for you. How do we manage our finance effectively? But strategic financial management is looking at long-term goals. How do we manage our finances in a way that helps us achieve long-term strategic objective and create value? So this is the core difference between both. Now let's see an instance. Let's say a company that wants to become the leading FMCG company in Nigeria, maybe let's say within the next 5 to 10 years. Now, the strategic objective will have financial implications, right? The management will need to ask, how much money do we need for expansion? Should we borrow or raise equity? Which market should we enter? What investments will generate the best return? How much profit should we retain for expansion? What financial risk could threaten the strategy? So financial management is not just about counting money, it is about making financial decisions that support the direction and future of the organization. So time has passed where accountants, they will just come and calculate, they'll prepare financial statements, you do your statement of profit or loss, you do your statement of financial position, cash flow, you just submit it like that. Those gone are those days. Now, the organization expects you to be able to analyze that financial statement and make decisions. That's what they expect now. And that's why we have ratio analysis in almost all the courses you're doing. That's why you have it, because those are the key things you need in order to draw conclusions on a financial statement. You'll be able to read a financial statement and tell the organization, this is what this means, not just about figures. So that is what strategic management, financial management is going to help every one of us to achieve, to know that you are not just there to calculate plus and minus, but you are there to do what? To help the organization make strategic decisions based on their what? On their finances. Now let's move further to stages in strategic financial management. Am I too fast? Please, somebody should mute and speak.
Good morning, ma. Please, I'm just joining in. Give me small time to Jot. Thank you.
Okay, you also have the notes after the class, but thank you for that.
Yeah.
So we were talking about introduction to strategic financial management, and then we have seen what strategy is all about. We have talked about strategy, and we talked about some scholars that defined strategy. So we say that strategy is not just about having a goal, it is about deciding where an organization wants to go, how it intends to get there, and what resources it requires to do it, to get to that particular place they want to go to, right? And we have seen that financial management also has to do with a strategic management that deals with the planning and controlling of the financial affairs that's of an organization to ensure that its objective, particularly its financial objectives, are achieved. So in simple terms, financial management is how an organization obtains their money and how they use it, right? Then how they control the money. One thing is using money, another thing is controlling the money. So you have to monitor that money you're spending, that investment, you have to monitor it and ensure when it's trying to go a wrong way, there should be a form of control to ensure that the organization's objectives are met. Okay, so let's proceed to stages in strategic financial management. So the first one there is setting out objective. Now that we understand the meaning of strategic financial management, setting out objective is the first step to determine what the organization wants to achieve. Now, when we talk about objective of an organization, a private organization, a organization that is not non-profit oriented. When I talk about that's the organization I mean, not NGOs, not non-profit organizations, right? Or not government organizations. We are talking about private organizations. So one of their objective could be increasing profitability, maximizing shareholders' wealth, increasing your market share. It could also be reducing costs, right? Or achieving sustainable growth, or even expanding their operations. Maybe they could be operating only in Port Harcourt and they want to move to Delta State, they want to move to Imo State, they want to move to Lagos. So these are clear objectives. So they should know what they want to achieve. First, they should determine what the organization wants to achieve. That is what we mean by setting out objective, because you cannot develop an effective financial strategy if you don't know what you are trying to achieve. Just like the ICANN students, I think it's about 92 or 93 days to November diet, and then someone is yet to set out an objective. Someone is yet to even say, I'm writing November diet. Some persons have not concluded their writing exams by November. So as many have not concluded their writing exam by November, they've not started lectures. So it is when you have set out the clear objective, November this year, I'm writing exams, then you will now begin to look for ways to achieve that set objective. So organizations must do what? Set out their objectives. That's the first stage in strategic financial management. Now, the second stage is identifying resources. Once the objectives have been established, the organization needs to identify the financial and other resources required to achieve them. Now, that objective that have been set, let's assume the objective is increasing profitability. Now, they have to now identify resources. What resources do we need to achieve this objective? For us to increase our profitability, maybe we don't have much staff. We don't have enough manpower. So they may be looking at their human resource. They're looking at technology. They may be looking at equipment. What are the resources we need? We need to identify them. What do we need? Do we need more staff? Is it a new project that requires more people to handle? You have to identify the resources that you need. Now, let's say that if the objective is to expand into new 3 states, management must also determine to know how much capital do we need. We need more staff, right? We need people. We need equipment. in order to get that done. So that is what identification of resources talks about. Now we move to the third one, analyzing data. Now, after having identified, you have set your objective, you've identified your resources, the next stage now is to gather and analyze relevant information before making decision. Just like someone that you want to sell, let's say you want to sell children wears, right? Now, for you to start up that business, you need to, make some findings. You need to make some findings. Where do I want to situate this my store? You don't go to a lonely close estate, a lonely close and estate. You go there and site that store. It is only people, you are only limited to people in that area, except maybe you want to have online presence. You now start advertising, telling people online, I sell clothes, they will not be ordering and you'll send. But if you really want to maximize people around you, you have to go in search of a place. It could be a marketplace. It could be a busy place where you know that people will see me, customers will always see me to patronize me, right? So in analyzing data for organizations, there are already historical data. That is why you have the financial statements, and then from the financial statement of, let's say, 5 years ago, last 5 years, you now have to do what we call budgeting and forecasting, right? You do your budgeting, you analyze from the historical data, you now budget what are we likely to see in the forthcoming 5, 6, 7 years to come. Now you have to also analyze the cost. What is the cost implication? What do we need to start up this business to achieve this objective? Now that we have identified the resources we need, what are the costs? If we have to hire more 5 staff, or if you have to hire 2 more professional accountants, chartered accountants to join the finance team, what is the cost implication? Abi, should we go for people that are not yet qualified? At least they will be kind of cheaper than going for people that are qualified. These are things they put in place. They tend to check, right? Now they also check the market condition. They intend to sell. What is the market like? What do people really want? What are people going for? Are there competitive products? Are there lookalike products? What do we do to make it different? How much is it going to cost us? Now you look at the economic conditions, of course. Anything you have to do now, you have to consider the economy. What are the laws of the land saying? What is the country economy saying? These are the ways you analyze your data in order to enable you achieve that set objective. So we move to the fourth one, making financial decisions. Now, after analyzing the available information, the management makes necessary financial decisions. They may include decisions about, now that we know we've set our objective, we identified the resources, we have analyzed our data. Now, how do we finance this project? That is making financial decision. Now, how do we finance the project? Having known how to finance the project, how do we make that investment? When we get finance of about 100%, do we invest the 100% at once, or do we invest 50 and watch it for some time before we proceed? Now, having made your investment decision, how about the dividends that comes out of it? Dividend decision. When do we start paying dividend? Do we allow the business to go like 5 years before we start paying dividend? What do we do? Do we pay some parts and keep some? They make these decisions. That is making financial decisions. So whenever you hear making financial decisions, your mind should go to how to finance the project, the investments of that amount of money you have raised from your sources of finance, how to pay the dividend, how to pay out to those that have contributed to that fund, right? So then, having known that, you also move to monitoring performance and identifying problems. That's supposed to be problems, not programs, so I will just have to edit it. Now, the process does not end after a decision has been made. You have made your financial decision. That's very good. That's fine. That's fantastic. But the process does not end there, because even after making decisions, if the decisions are not properly monitored, there could be a downside of it that could affect or cost the company a lot. So the management must continuously monitor the performance to determine whether the organization is achieving its objective. That's why we have budget monitoring. Some organizations do that every 3 months, right? Every 3 months, they tend to get their actual from their budgeted, they calculate the variances. They now try to identify why is our profit lower in this time. As at last 2 months, we had profit of 100,000. Why do we have profit of 80,000 in this month? You monitor the performance of what you are doing, right? Now, having checked that our profit reduced, now you now try to find out, that is identification of the problem. Why is our profit lower? What happened? Is it because our revenue of course, you should know that it is your revenue minus your cost of sale will give you your gross profit. So when you're looking at the gross profit part of it, and your gross profit is lower than what you used to have, now the two factors that have affected it is the revenue and the cost of sale. Now it's possible that the revenue dropped from what it used to be, or that your cost of sales increased. For those of you that are doing your SBR, at least you should, this is a part of a ratio analysis that you should actually put your head to, because one thing is calculating the ratio, and another thing is being able to, identify the differences in that ratio, be able to explain whatever the calculation of your calculation of ratio may be wrong. The answer may is supposed to be 25% and you have 10%. That's not what the examiner is looking at. If you are able to defend that your 15%, if you're able to prove to the examiner that this is the reason why it's 15%, you get the mark. So monitoring performance and identifying the problem, why is it so, is another thing. So the management must continuously monitor performance to determine whether the organization is achieving its objective. So like I said before, maybe the company plans to increase the profit by 20%, but the actual profit now increased only by 8%. Management will now have to ask, what happened? Why did we not achieve our target? Did our costs increase? Did sales decline? Did the market change? Did we implement a poor strategy, or was there inefficient resources? Maybe we needed 5 staff, we only used 2. Is that why? So these are the things they need to monitor and then identify, so that they'll be able to profile solution in order to achieve the set objectives. Can we proceed? Should we proceed? Any question?
Yes, ma'am.
Okay. So let's move to objectives of a company. Now that we have understood what strategic financial management means and how financial decisions are made, now the next question is, what exactly are we trying to achieve? Right? So in other words, what is the objective of a company? Every organization exists for a purpose. However, for a business organization, the primary objective is generally financial in nature. So we have both financial objective and non-financial objective. So now we are going to look at the primary objective, which is financial objective. Now, every organization exists for a purpose. The primary objective of a company is financial in nature. The primary objective is directed to the benefit of a single stakeholder group. Of course, we know that there are different stakeholder groups, right? We'll see that also when we move further. We have the shareholders, we have the employees, we have the directors, we have the suppliers, customers, and all of that. But now, talking about primary objective, that is financial objective, it is looking at only the shareholders, that they are the owners of the company. So it is generally assumed that the primary and sole objective of an organization is to maximize shareholders' wealth. To maximize shareholders' wealth, because they are the owners, they are the ones that have invested so much in the company. Now, when you're talking about maximization of shareholders' wealth, what does that mean? It means that the company should what? Make decisions that increase the value of the wealth belonging to the shareholders. The value of their wealth. You invested 10,000 naira. The company should ensure that 10,000 naira, the value of that 10,000 naira will increase, so that at the time of making returns to you, they are not just giving you 10,000 naira, they are giving you what's more than that. Now, in simple terms, shareholders invest their money in a company because they expect a return on that investment. So many persons that buy shares, MTN is selling shares, they will go and buy any company, Dangote now is selling, they will buy. The essence of investing in those companies is not just because you feel like, let me just go and drop the money there. No, the essence is that they're expecting a return on that investment. And then that return could be in form of dividend. That's a portion of profits distributable to shareholders. When they have removed their expenses, they have their profit. Now it is from that profits, they have paid their tax and all of that. That amount of money that is remaining in the company that they intend to keep. Now, from there, they will now decide, should we pay the shareholders as dividend or should we keep it? Right? So they can benefit, the shareholders can benefit in two ways. Could be through dividend or increase in share price. Of course, we know that when the value of a company share increase, the wealth of the shareholders will also increase. Because if peradventure they decide now to say, I want to sell off my shares, of course, you know they are going to sell it higher than what maybe they bought it 1 naira per share. When the share price increase, it may go to 3 naira. Of course, you know what that means for someone that maybe has 5 million shares. That's what it means to have an increase in share price. So when you also talk about shareholders' wealth, we're also talking about the present value of the future cash flows available to the what? To the equity shareholders. That is present value of their future cash flow. I believe you people have done investment appraiser. I believe you've done that too. So now let's move forward. The reason for this assumption is that of all the stakeholders in a company, the demand of equity shareholders are paramount. Equity shareholders are dominant because they own the assets of the company and employ directors and managers, that is decision makers, to make the best use of those assets. Ultimately, if directors do not produce at least adequate returns for shareholders, they will be out of job. Of course, the company belongs to shareholders, so they can decide to say, okay, since you people are behaving like this, we are not doing again. All of you, leave this place. Let's get new managers. So that is why the managers are meant to, utilize the resources to ensure that there is adequate return for shareholders. Now, let's proceed. Some common financial objectives of an organization are as follows. The first one, we have maximization of profit. Now, the company may aim to increase the difference between its revenue and its expenses. Now, the company may want to say, for example, a company may set a target to increase annual profits from 500 million to 700 million. However, that profit maximization is not exactly the same as wealth maximization. A company can report high accounting profit today and still make decisions that destroy long-term shareholder value. That a company is having a high profit on their statement of statement of profit or loss and other comprehensive income, that a company is reporting a high profit does not automatically mean that their shareholder wealth has been maximized, because there could be a wrong decision that will make that profit. It will look like they've never made profits all the years. So some common financial objective will be maximizing profit. Now that we have made this profit, what do we do with it? Then they also maximize earnings per share. The earnings per share there represent the amount of profit attributable to each ordinary shareholder. So a company may set up an objective to increase their earnings per share from 10 naira per share to 15 naira per share. So increasing EPS can maybe indicate improved, yes, it can indicate improved profitability from perspective of ordinary shareholders. So when their earnings per share increases, the ordinary shareholders we say yes, the company is improving. But however, just like profit, earnings per share should not be considered in isolation when assessing shareholders' wealth. Then we have the next one, increased revenue. The company also may aim to increase sales revenue. They may say we need to increase our annual sales from 10% to 20%, or we need to increase our annual sales by 20%. Some of those questions you solve, maybe you are looking for your cash flow statement in order for you to do an investment appraisal. The way ICANN will tell you sales increase by 10%, increase by 20%. They expect you to know what to do with that their 10% and 20%. You are supposed to do what? To forecast it, to analyze the cash flows, apportioning that percentage that have been given to you. So when such thing happens, you see that there will be a higher revenue as the budget is being drawn, as the analysis is being drawn. So when the company wants to increase their revenue by 20%, higher revenue will be achieved. But that does not also mean that what there is higher wealth maximization. So if revenue increases while costs also increase faster, then the profitability and shareholder value will actually fall. Imagine that your revenue increased by 20% and then your costs also increase by the same 20%, then the increase is of no use, right? Because it's not affecting what comes back to the shareholders. So these are objectives that need to be set. As we are increasing our revenue, our costs need to be monitored. And that's why we have the fourth one, reduction of cost by X percent. Now, in reduction of cost, the organization may look at in reducing their operating expenses. Now, cost reduction can improve profitability and cash flow, provided the reduction does not damage the quality of the company's products or services. Because some organization may want to say, okay, let's not go for ACA, let's not go for chartered accountant, let's just go for maybe BSc holders that are not chartered yet. Now, there are some things that a chartered accountant that has gone through these rigorous trainings, you can testify what you are going through in the process of becoming a chartered accountant. There are some knowledge, that some things you know now that you didn't know while you were in your first degree. Now, this knowledge is an addition to you. We are not just learning here just for learning's sake. We are learning to apply. So when you go out there and people see you, this person is an ACA, you'll be able to give out. It's not just having the paper, right? It is being able to, prove it. Let people see you, because when they see you as ACA, they see you as an authority. If you work in an organization where you are the only ACA, that's when you understand that ACA is not beans. They see you as an authority. So this knowledge will help you to apply it in your place of work. And then people will know that, of a truth, the finance manager or whoever will say, this person can actually do this. So in cost reduction, for those of them that have not really understood that increase in revenue when there's no reduction in cost does not mean that the business will be profitable. You see that when the revenue is increasing, some of them will feel that more money is coming, let's spend money, right? If maybe they used to use diesel of 10 liters, they'll still be, in fact, they may even increase it to 15, 20 liters without being conscious of why are we increasing this cost? Can't we reduce it? What do we do? Being mindful of the cost implications of what is happening in the organization. You see that at the end of the day, the effect of the increase in revenue will not still boil down to maximization of shareholders' wealth. They will still be having low or no profit. Then there's improved cash flow. Another financial objective is to improve cash flow. Of course, a company may also set an objective to improve its cash flow. But remember that profit is not the same thing as cash. I know that we should know that a profit, that your company makes profit, is not the same thing as a cash. That's why we have the cash flow statement that tells us how the company was able to generate its cash, how the company invested it. That's why we have a cash flow from operating activities, from financing activities, from investing activities. So these are the breakdown in the cash flow statement that will help you to understand truly what happened in the organization. It's not about seeing we have 100 million naira profit. Let's go and look at the cash flow statement. How did we come about this, right? So we should also put that to remembrance that when we try to improve cash flow, we should also ensure that the company has enough fund to meet its obligations and finance its operations and investments. So the last one there is increase market share. A company may also aim to increase its share of the market. For example, if a company with a 15% market share may set a target to reaching 25% market share, that is maybe when it comes to a market and then we have 100% and only your organization is having 15% of that market share, or only your product is having 15% of that market share, you will try as much as possible to make the market share move from 10% to 20 to 30%. Maybe it could be, you could try to do some kind of advert, you could add some unique things to your product so that your market share will increase. So when the market share increases, then there will be the company's competitive position will be strengthened. The company will be able to compete when the market share increase, because you have reason now to compete. People now know my product. People are aware of my products, right? Now the company will be able to compete in the market. So growth at any cost is not just necessarily. It's not just necessarily value creation. It is also very important. However, they must consider the cost of achieving that growth. Very, very important, because if you're achieving a growth and the cost of achieving that growth is high, you discover that at the end of the day, it will look like there was no growth at all. I hope we are following. Should we proceed?
Yes, ma'am.
Okay, so we have the next subhead here, measuring the achievements of financial objective. Measuring just the same thing as financial performance, measuring your financial performance. To measure the achievement of this objective, financial ratios may be used. So this talks about the ratios or the indicators, things that indicate that a company is actually doing well. This particular part of this syllable is very, very important, because you will see it in your SBRO, you will see it in your, of course, some of these things, you'll see them as you proceed in SFM. You have to compute your market price per share, earnings per share, and all of that. Then you also see it in your case study. That one is compulsory. You also see it in your case study, because you have to analyze the case that is given to you by giving the performance measurements. So you need to take this particular aspect of the syllabus very serious, because it cuts across other subjects, other courses. Now, the first one, we have profitability ratios. Now, by now, we should know this, that this ratio helps to analyze the profitability level of a company, right? It helps to analyze the profitability level of a company. It tells the users, it tells the people what a company is all about. Is it growing in terms of profits or not? So when you hear profitability, your mind should just go to the word profit. It helps to tell whether the company is profitable or not. And so the following ratios are relevant to have the gross profit margin, we have the operating profit margin, we have the return on capital employed, and we have return on equity. So whenever you hear gross profit margin or any, like you say gross profit margin, you know that it is the gross profit over revenue. Operating profit margin, you know, is the profit before interest and tax over revenue. So I don't know if we should emphasize more on these ratios, because I have a question I would like you to try, but let's proceed anyways. So we have the liquidity ratios. These ratios help to measure ability to settle short-term obligations with long-term assets. The ability to settle short-term obligation with short-term assets, right? Now we have our current ratio, quick ratio. Current ratio is the current asset over current liability. I know by now you should know what the current asset is. You have your receivables, you have your inventories, you have your prepayment. These are current assets. Then you have your current liabilities also. We have your accruals, you have your payables, right? Now, these current assets should be able to settle the current liability, that is short-term obligations. Current liability are the same thing as short-term liability, right? So your current asset should be able to settle your current liability. We also have quick ratio, where you now say the current asset, now you want to remove inventory, because inventory is a major part of working capital. So if the inventory is there in the current ratio, okay, now let's remove inventory. Let's see if the company will be able to meet its short-term liability without inventory. That is why quick ratio says, oh yeah, current assets, remove inventory and divide by what? Current liabilities, and let's see what happens. So we also have the long-term solvency ratios, which measure the ability to meet up with long-term obligations and helps to ascertain the financial risk level of a company. See that again. It measures the ability to meet up with long-term obligation. Now, this liquidity ratio talks about short-term obligation, while long-term solvency ratio talks about long-term obligation. So now we now have debt to equity ratio, which is debt over equity. I hope you know that this debt to equity, let's assume we have 20% debt and 80% equity. Now, when you say debt to equity, you are saying that debt 20% over 80%. Now, the second one is debt over debt plus equity, right? Now, we have before our debt 20% and our equity 80%. Now, for debt over debt plus equity ratio, we will now say that the debt is 20%, then debt plus equity will now be 80 plus 20. That's when you now have 20 over 100. Sometimes students don't understand this. So when they see debt to equity ratio, sometimes they'll go and carry 20% of debt over 100%. You should understand what the question says before you know which to apply, whether they are just talking about debt to equity, that is debt over equity, or debt over debt plus equity ratio. Very important. Then we have the interest cover, that is profit before interest and tax over total interest. This one is just trying to tell us how much profit is, how many times the profit is going to, cover up the interest that the company has to pay. How many times will our profits cover that? How many times? That's what interest cover talks about. Then we have investors ratios, measures how well investors are being compensated for funds they invested in businesses, right? So we have your earnings per share. That is, patos here is profit after tax. I wrote them here, profit after tax or profit attributable to ordinary shareholders. You see the explanations below. So we also have dividend per share. That's your total
Can't hear you. Or is it my network?
No, our network
She's on
is.
network. She'll definitely come back.
Oh, okay.
So as she's trying to come back, I have some questions after our class. We're going to look at some questions in relation to these chapter 1 of the strategic financial management. I'm also going to forward to her so she can incorporate into the material she's going to make available to the group, so that you see how questions can come in diverse ways as it relates to this chapter. So I've put those questions together. We're going to discuss some of those questions when she's through, so that we can be tested on all what we've been hearing. So let me see. Let me reach her on. Well,
Sorry about that. I didn't know I left the call earlier. I didn't know. So let me share again. Okay. Okay, so let's proceed. Can you hear me?
yes, we can hear you.
Okay.
Yes.
Okay, so I was talking about investors ratios, where you want to measure how well investors are being compensated. So we have earnings per share, that's the profits attributable to ordinary shareholders or profit after tax, whichever one you call it, over the number of ordinary shares, right? So then we have dividend per share, the total dividend divided by the number of ordinary shares. Then we have total shareholders return, that is your dividend per share plus capital gains. You'll be able to understand this more when you see it in a question. So I'll get a question so we can do that together. So these are the variables. So those ones I use short words or short sentences. So like DPS, dividend per share, and all of that. Okay, so let's proceed to having treated the primary objective, which is the financial objective of a company. We are moving on to the secondary objective, which is the same thing as non-financial objective. Now, the objective of a company towards stakeholders other than shareholders are non-financial in nature. Now, to properly understand it, we should be able to identify who these stakeholders are. Who are these stakeholders? Those that have interests in the operations of the company. There are people that have interest, not just the shareholders that invested now. Now, these people, they do not have investments, direct investments, like they are not the owners, but they are also people that has interest in the organization. Of course, we know we have in an organization, we have the employees, we have the management, we have your customers, you have your suppliers, you have the society where the organization operates, that place that the organization is situated, the society also has an interest in that organization, and then the government. So each of these stakeholders have their own interest. And because each stakeholder's interest is different from the other person's interest, that's why there is conflict. That's why there's conflict in the what? In the interest of stakeholders. Now let's see the first person, the employees. So a company, the welfare of employees is paramount to the organization. A company might try to provide good wages and salaries, comfortable and safe working organization. These are the things that employees need. Of course, you need a good pay. It's not this one that you go for interview. They will ask you, why should we hire you? And some of us will say, I want a more challenging opportunity. I want a more challenging environment. Me and you, we know that the pay is the cocoa. So a company want to try and provide good wages and salaries, so that the staff will also be happy to work with the company. Then there should be a comfortable and safe working conditions. The work environment should not be hectic. There should be a comfortable work condition. There should be good training and career development. There are organizations that they don't even want their staff to grow. I think I've seen one of that organization before, where a staff wants to, embark on a particular career advancement, and the organization is trying to pull the staff back from doing that, telling the staff, if you do that now, you will not be able to meet up your job. There will be loss of distraction. So these things are what should be put in place in an organization. Organizations hold trainings. Even this ICANN exam, some organizations sponsor their staff to do it because it's part of career development. Then we have pensions. Of course, the pension is mandatory. It's mandatory statutory obligation that the company needs to do for whoever is working with them. So, and also if there is time of redundancy, maybe there is time of layoff, many companies will also do what? Provide a generous redundancy payments, right? Or even find some alternative positions or employment for their staff. So this is what we mean by the welfare of the employees. Moving on to the welfare of the managers. Managers will often take decisions to improve their own circumstances, even though their decisions will incur expenditure and so reduce profits, right? Now, the managers of the organization, they will want to make decisions like incentive. I need a car. As a manager, I don't need to be entering bus, jogging from one bus to the other. I need an official car. I need high salary. I need high incentive. These are the welfare of the management. Management wants these things for themselves. Now, sometimes they don't even care if their decision is going to reduce the profit of the organization. This is where their self-interest plays, right? They don't care if it's going to reduce the profit of the organization, thereby reducing the shareholders' wealth, the main owners of the company. That's why we have conflicts between the managers and the shareholders, because their individual interests are not the same. We are going to look at their conflicts also. So the welfare of the management is being considered when it comes to non-financial objectives of a company. So we have the welfare of the society. The management of some companies is aware of the role that the companies have to play in exercising corporate social responsibility. So organizations situated in a given community, there are some of them that even go as far as employing some people in the community. If they are not, qualified for higher level role, they can bring them in, make them their janitors, and make them their receptionists, or depending on their ability, right? So, and then they also help to ensure that if they exhume pollution and other harmful externalities to the environment, they ensure that they know how to manage it so that the people will not get what affected. So this is what the organization owes. I think currently they've been testing this corporate social responsibility, ESG. I think I've been testing this for a long time, and there are some couple of seminars that have been going on it also. So it's very paramount that organizations will put this in place to ensure that where they are situated, the organization is not affecting the community negatively by the kind of services they render. Like there are some places that you say there will be oil spillage. I think some parts of River State, sometimes there will be oil spillage to affect their water, affect the land. So organizations should ensure that things are put in place so that the community where they operate will not be affected negatively. So that is the welfare of the society and community. Then we have their customers, of course, customer satisfaction. This involves the satisfaction of customers in terms of quality products, right? Don't give your customers substandard products. Give them quality products. There are some substandard products, especially what people consume, what they eat, that are harmful to the body, right? So you ensure that the product you are giving out is a quality product, and then there is timely delivery of items, not when customer makes order by Monday till the next week Monday, the product is yet to be delivered. It does not bring satisfaction to that customer. So these are some, objectives, some objective that the organization needs to set out that, please, our customers are paramount to us because they are the reason we are in business. So timely delivery is of essence. So that is that for that. So we have fulfillment of responsibility towards what? Suppliers. Those suppliers that give you those products, you buy from them. Some of them can even allow you to, buy and give you some number of days to pay. It can be 30 days, it can be 60 days. Now, your ability to pay those suppliers on time will strengthen the relationship. So let's read what responsibility towards suppliers are expressed mainly in terms of trading relationship. A company's size could give it considerable power as a buyer, right? Now, the company should not use its power unscrupulously. That is, you have money to pay your suppliers. You're using it for something else. You don't want to pay them. You're holding back their money, delaying their own business. So suppliers might rely on getting prompt payment in accordance with the agreed terms of trade. When you have agreed 30 days, 60 days, that's why some companies, they have what they call accounts payable reports and account receivable reports. So if you're the one who sold on credit, of course, when it's time to demand, you generate the report and say, okay, this person is supposed to pay me this week. You send a reminder, please, we have not gotten our money. When are you paying? So the ability of the company to fulfill its financial obligation, pay your suppliers on time, we strengthen the relationship that anytime you call them, they can go out of their way to ensure they deliver those goods to you or those services to you. So we move on to the governments. Of course, you know that the governments, they are very much interested in your compliance, the organization compliance, ensure that tax is paid when it is due to minimize unnecessary liabilities, right? And you know that those liabilities can reduce your earnings. That is why any unnecessary penalty, not even unnecessary, penalty is penalty. Any penalty you have in your statement of financial position or in your financial statement of profit or loss, you have penalty. It is a disallowable expenses, because that penalty is as a result of your negligence. It's as a result of you not doing what you're supposed to do at the right time. So if you go to your pay your tax and maybe you did not pay when you're supposed to pay, and then there's accumulated penalty on your portal, after paying that penalty, you come to your income statement and you go and write there penalty 100,000. When it's time for tax computation or tax payment, they will add it back. they will say, no, this one is your fault. We will not allow that, right? So you ensure that the government is there to ensure that tax is paid as at when due. Of course, there is self-assessment. For those of you doing tax, there's self-assessment. You know, you're supposed to assess yourself and pay it. But that doesn't also mean that the tax people will not check what you have done. There will be time for tax audits. So in that time, they will ensure that you yourself should ensure that your books are in order to minimize unnecessary liability. So this is also an objective of the company. So this objective may reduce short-term profit, but support long-term value creation. Now, what does this mean? In the process of trying to check and ensure that the employees, welfare are put in place, they are paid a competitive salary, the management is paid a competitive salary, the community, of course, you have them in mind. All these things will reduce your profit. They are going to increase your cost. That is true. But what happens is that on the long run, you will enjoy the value you have created. Imagine a company that is not good at paying salaries promptly, right? Now you keep on losing your staff. Before you know it, they will leave. You post again. Chartered accountants needed. Apply ability to resume immediately. Now you get another person. That person will work 2, 3, 4 months. The person leaves. You post again. Now people are seeing your job adverts. People are seeing it, and they are beginning to note that this company has a high turnover of employees. They're always looking for staff. What's the problem? What's going on there? You understand? And I've seen people that when they call them for interview, they'll come to a group and ask, please, who knows so and so company? I've been in a group where people come and analyze the company. They'll tell you, don't go there. This is what it is. People are seeing. So these objectives that you create will help the company in a long run. You will not have such record outside there. People are watching, but the organization may not. Some of those companies don't know that people are watching. They think there will always be accountants. There will always be somebody, but people are watching. I hope we are following. Okay, let's proceed. We have decisions in strategic financial management. We've looked at this. Yeah. Strategic financial management involves taking some strategic decisions. Okay, can you still hear me, please?
Yes,
Yes,
ma'am.
now we can hear. Yes, ma'am.
Okay. So talking about investment decisions, this involves deciding on what short-term investment to invest your cash surplus. What kind of investment should we do? Do we do long-term projects? Do we do short-term projects? Which one is more profitable to us? Is it long-term or short-term, in order to ensure maximization of shareholders' wealth? So this is where this decision comes in place. What investment should we move to? Is it short-term? Is it long-term? Right? So a project that you want to achieve within 1 year, of course, is a short-term investment. But if you're looking at a project that can take you 5, 6, 7, 8, 9, 10 years, you have to be patient with that investment. So you still check, what kind of investment do we want to do? So these are the decisions that the strategic financial manager does. Then we have financing decision. Having made your decision on the kind of investment to do, how do we finance it? How much do we need? Who are those people that we can get the funds from? Do we do equity? Do we do debt? Right? Now, if you're going for equity, you should know why you're going for equity. If you're going for debt, although some companies these days want to always go for debt. But if you have more debts than you have equity, then you can say the company is highly geared, and At the long run, it will not look good on your statement. So we also have, also the associated cost of raising those funds. That's your cost of capital. I know you have treated cost of capital and project-specific cost of capital, where you ungear and regear. So these are decisions that the financial manager does. When you have decided on how to raise your fund, how do we do it? Now, that fund we have raised, what is the cost? If you're using debt, what's the cost of debt? The interest. Is the interest high? Is the interest low? These are things you look at for in the financing decision. Now, we now have dividend decision. This is deciding on how much profit should be distributed to the equity holder and how much should be retained in the business for expansion purposes. How much do we pay them? What percentage should we pay? Should we pay 20% and keep 80%? Should we pay 50 and keep 50? These are decisions that are being made by the management. So we now have risk management strategy. Now, decision on the most appropriate method of hedging the firm against financial risks, such as exchange risk, interest rate risk, credit risk, and all of that. Now, I know if you've not done hedging, I know you'll get to that. So this is a way that the management, makes plans or make appropriate decision on how to hedge, on how to help the company to minimize its risk, its financial risk. Could be your foreign exchange risk, right? Now, when you're buying foreign currency or when you're selling foreign currency, you have to be able to analyze and check the risk involved so that at the end of the day, the company will not be at the losing side. So we proceed to the role of a financial manager. The role of a financial manager is advisory in nature. These include, but not limited to, of course, you advise around investment decision, you advise around financing decisions, you advise around dividend decisions, you also advise around the risk, financial risk management decision. It's just the same thing as those decisions. So when they ask you what are the roles of a financial manager, when you have remembered that they have investment decisions to make, they have financing decision to make, they have dividend decision to make, just tell them that their role is to advise around this, advice for this, advice, just like that. And before you know it, you have gotten 5 marks, 5 marks, so without stress. So also we have communicating financial policies to the stakeholders, both the internal stakeholders and the external stakeholders. The internal stakeholders, those in the organization, the external stakeholders, those outside the organization. Those outside the organization, you have your suppliers, you have your vendors, that's your vendors are the same as suppliers. Then we have your customers also. You have the governments. That's why they see the financial statements. The government looked at it. The tax authority, they have access to your financial statement. Sometimes, some companies, some of these listed companies or quoted companies, they publish their financial statement so that all stakeholders can go and look at it. So that is what a role of a financial manager. They communicate the financial policies to the stakeholders, and they do this by preparing their financial statement where you have the company policies, the company affairs, everything that has to do with the company is written there, their ESG and all of that. So they publish it for the public and the stakeholders to see. Are we together?
Yes, ma'am.
All right. So we move to the treasury function. In an organization, for big organizations, they have treasury departments separate from finance departments. Yes, there are organizations that are very big, like multinationals. Multinationals, they have treasury departments separate and then finance department separate. Now, the treasury function plays a vital role in an organization's financial management. We have financial management, we have financial control. These two are not the same. Financial management financial control. Now, the financial management looks at, how funds are gotten, how funds are going to be spent, and how investments are going to be done, the dividend decision and all of that. This is the financial management of it. Now, the financial control part of it is looking at how do we pay salary, how do we pay suppliers, how do we pay our customers, how do we pay our tax. These are the financial control part of it. So that's what we see normally in our finance function. They're always there to, have you pay salary? If it's salary week, you see everybody becomes the friend of people in finance. They can even buy you lunch because it's salary week so that you process salary fast. Yeah, right? So this is the finance control part of it. While the financial management part of it, which is the treasury function, has to do with making those strategic decisions on how to get the funds, financing, investing, and dividend payments. I hope we understand that. So the treasury is concerned with relationship between the entity and its financial stakeholder. You see that is concerned with the relationship between the entity and its financial stakeholders. And who are these financial stakeholders? The shareholders. So their concern is these people, which includes shareholders, the lenders, tax authority. Now, cash management in a large organization is often handled by a specialist department known as the treasury department. This is for large organizations like the multinationals, but some of these are private sectors these days. We have everything in one department. We call it finance and accounts department, where you now have somebody to be the treasury accountant who is in charge of receiving and disbursing the funds. Then they now have other people, have financial accountants, who have some have receivable accountant and all of that. So, but the cash management in large organizations is often handled by a specialist department known as the treasury department. So the treasury deals with the management of the liquidity and the risk exposed by a firm. Now, when you're talking about liquidity, of course, you know that they are talking about their cash, right? Now, they are looking at how do we manage our cash? How do we handle it? How do we invest? What are the risks that are exposed to the firm? Now, if the company is always is good at selling on credit, they are exposed to credit risk. The company is exposed to credit risk because there's possibility that the person that bought from you we no longer continue in business. The business is no longer a going concern. So what do you do at that point? You have lost that money. And this risk is mostly attributed to banks because, they loan money to customers. I know that so many people that collected money from bank to do business, maybe they invested in a wrong business or they were scammed, and they will not hear a call. Anyway, that money invested, no more. The 100 million has gone. The person will just collapse and die. The bank has lost that money. The bank has lost that money. Although some of them go as far as having to, short-let use their house properties and all of that as a collateral for that particular this thing. But so many banks has lost huge amount of money in that aspect. So it's a risk to them, credit risk, right? So the treasury deals with management of liquidity and the risk exposed to by a firm. So every firm should be able to identify their own risk depending on the kind of business or the kind of activity they carry on. So we move to the key tasks of the treasury can be grouped into 3 levels. We have the strategic levels, we have the tactical level, and we have operational level, just like we have levels of management in our CSME. So everything is just tailored together. It's just your ability to understand what they really want you to write and be able to write. It's just paying attention to details. That's what it demands. Just read the requirements of the question, then go to the main question. Then you'll be able to know what you are asked to do, and then you put it down. So we have strategic level. This involves matters concerning the capital structure of the business. The capital structure, right? who are the people raising the capital for the business, and then how are the returns going to them, and then if at the long run we need more finance, how do we go about them? That's where they now go for debt financing and all of that. So when you're talking about strategic level, your mind should go to the decision of financing and how returns are going back to shareholders. So your mind should also go to financing and dividend decision. Then we now have tactical level, where the decision places on investment. Having gathered the funds, how are we going to spend it? What are we going to invest on that will yield us maximum return? So that's the tactical level. Just like you have the strategic level management, tactical level management, and operational, right? Then you should know that the operational is the lowest level. This involves relating with banks. Who is going to bank today? Bank where you want to make payments. Sometimes they want to pay salary. They upload the schedule. They call the bank. We uploaded schedule. Please pay this supply and all of that. So this have to do with relating with the banks. What to do with surplus cash? Just operational activities, right? Operational activities. So the Treasury departments are also responsible for the following. Now, these three I listed here are the groups, right? But all of this now I'm about to talk about are inside this group. So there could be a question. I think there's a question like that where students were asked to write the groups of the levels, the three main levels of the tax for Treasury department. And so the examiner's comments still say that students did not understand the question. Of course, it's possible. In exam condition, what you know already, there could be a way before you know it look like you never saw that thing in your book. So we need to pay attention to that. So the Treasury department would also be responsible for liquidity management. Under this role, the department ensures that the firm has enough cash to finance its short-term obligations, right? Liquidity has to do with your cash, your ability of using your cash, right? When you're talking about liquidity, just your cash, what do you have? What do we have to settle our obligations, our short-term obligations? So it also ensures that the firm does not hold unnecessary excess cash, right? There are some managers that are afraid of taking risks. Is it risk averse that you call it? Yes, they don't have that appetite. They don't have risk appetite. They are always scared. Yeah, even some of us, we do it. They will tell you, invest in this, you are scared. This is my 100,000 naira now. Let me not go and lose it now, and nothing for me, right? But these ones now, they do not unnecessarily hold cash. They look for, now that we have this money, what do we do? How do we invest in it so that the cash will not be lying idle here? So when the firm has excess cash, this should be invested in short-term financial instruments to earn interest. So this is what liquidity management is all about. Being able to ensure that the firm has enough cash to sort out a short-term obligation, and then where there is excess cash, they should be able to invest it in short-term financial instruments to earn interest. It's not investing it in MMM. It's investing it in financial instruments or in project that can bring forth interest to the organization. So we now have risk management. The department also assesses the risk in which the firm is exposed to and decide on which risk management technique to adopt by the firm. I think there's an aspect of risk in SFM. We'll also look at that. So the organization or the department, that's the finance department or the financial management, we have to assess the risk the firm is exposed to. So how do we handle this risk? If we are exposed to interest rate risk, so what do? We should look out for loans that's for debt financing that their interest rate is low. Or what do? Let's start paying off so that it will not keep on accumulating. You also have the exchange rate risk. You have market risk and all of that risk. So is when you are being able to identify the risk that is facing the company that you'll be able to know the right technique to adopt in order to manage such risk. So we proceed to corporate finance. This involves deciding on the direction of growth for the firm. So it also involves analysis of potential investment opportunities and acquisitions to ascertain whether they will add value to the firm or not. So this has to do with looking at investment opportunities. Are you looking at taking over a company, like acquiring a new company? That company you want to acquire, have you looked at it before? Have you carried out your due diligence? Have you looked at their financial statements before you try to venture into that? So they look at potential investment opportunities. They try to make some due diligence before they venture into either merging with a company or acquiring a company. Now, if before you merge with a company, you should also look at what do they do, right? If you are looking at diversifying, let's say you're selling tire and you're looking at diversifying to selling of car battery, you're already selling car tire. Now you see a company that is into car battery and they're asking you for a merger. Now if you see that as a business opportunity for you to diversify into selling battery, you venture into it. But not that you're selling car tire and another company now is selling exercise book, and you want to go and carry yourself and merge with a company that is selling exercise book. You see that the two businesses does not correlate. Before you try to bring them together and start making your money back, it's going to take a long time compared to you merging with a business where you're already in line with that. I hope we are following. Okay, so let's proceed. Thank you. Let's proceed. Funding management. Under this, decision on which source of finance to obtain to fund investment opportunities or to meet short-term obligations will be made. These are things we have been repeating. SFM has a way of taking you back to what you have learned. As you move to the next topic, you see things that you've done before. It's just like a refresher to keep you going. So fund management is just like making decisions on the sources of finance. How do you get your funds to do what? To invest in opportunities, and how do you manage your funds in order to meet your short-term obligations? Then we also have purchase and sale of foreign currency. These things, remember, these things we are talking about are decisions or are activities of the Treasury Department. These are functions of the Treasury Department. Don't forget that, right? So they engage in liquidity management, risk management, funding management. Then they purchase and sale of foreign currency. Assume that you have a foreign currency to sell in order to use to get naira, because this is your local currency. This is where you are operating from, your operational currency. Now, for you to sell that foreign currency, somebody needs to make arrangements with the bank or whoever is buying it. And then the person also needs to know that when you're buying foreign currency, what is the applicable rate? When you're selling, of course, you know that the amount bank buy from you is not the amount they'll sell from you. When they are buying from you, they buy at a lower price. When they are selling to you, they say high. It's their business, right? They need to make profit. So the decision to sell foreign currency or to buy foreign currency lies in the Treasury Department. The unit arranges purchase of foreign currency when needed and arranges the sales of foreign currency cash receipts. In a nutshell, the Treasury ensures the organization has the right amount of cash at the right time at the lowest possible cost while managing financial risks. So some Treasury Department, if they see that when they want to sell, they see that maybe the bank rate is low, then there are other entities that also buy in a higher price than the bank. They want to sell to those people. Why? Because they want to maximize that opportunity. They want to make more money for the organization. So these are the activities, these are the functions of the Treasury Department. So let's move on to types of Treasury Department. So there are two types of Treasury Department. We have centralized Treasury Department and we have decentralized Treasury Department. From their name, centralized, decentralized. Centralized, is one department that is controlling all treasury function. Decentralized, that it has different units, maybe different units will have their own different. If it's a group company, then it means that each subsidiary will have their own treasury department. But if it's centralized, it's only the headquarters that you have the treasury department. Now let's see the notes there. Under the treasury department, only one treasury, under the centralized treasury management, only one treasury department is set up. These departments will be responsible for managing the fund of other branches and subsidiaries across the globe. It is concentrated in one unit, right? That is the headquarters. While the decentralized treasury management, under this, each company in the group will have its own treasury department and appoint an officer who will be responsible for the company treasury operations. So the treasury function is distributed across various business units. So from their name centralized, one department will be responsible for managing the funds of all their branches and subsidiaries. So it's just concentrated on the headquarters. While the decentralized, each unit or each subsidiary or each group will always have their own treasury department, and then they will appoint an officer who will be responsible for their treasury operations. I believe that is clear. So we move on. Are we tired? Are we tired?
No. No.
Am I
No.
too boring? Is the class boring?
No.
Okay.
No,
No, it's actually very
Good.
lively.
it's
Okay.
interesting.
So we proceed to the advantages of centralized treasury management. We have bulk investment and borrowing. We are talking about decentralized now, the one that's in headquarters, one treasury department controlling all. Now, one of the advantages is that there is bulk investment and borrowing. Everything comes in a bulk, right? Now, when more than one subsidiary have surplus fund for investment, such fund can be pooled and invested in order to earn a high interest. Now, let's say, for instance, they have company ABC group of company, have subsidiary A, subsidiary B, and subsidiary C. Now, if subsidiary A, B, and C have some surplus cash, that they are not using for anything, they cannot carry it and go and do investments because of what? They have a centralized treasury management. So what they do is they all bring it together and give it to the headquarters where you have the centralized treasury management, and the money is invested in order to get a high interest. Of course, you know that something that has advantage will also have disadvantage. We'll see to that. But right now we are talking about the advantage, right? So there is bulk investment and bulk borrowing. Even if there is lack of money, maybe some subsidiary need finance, the borrowing will also be done in bulk, right? And then they will distribute it in order to distribute it to those groups or those subsidiaries that need it at a minimum interest. Then we have set off. When a subsidiary has surplus fund and another is in need of finance, these amounts can be matched, and this will result to saving in interest. Now, what this means is that if company A and A, B, and C are subsidiaries of ABC Limited, now company A has 200,000 naira surplus, right? And then company B is in need of 100,000. Now, the treasury department, being a centralized system, we know that company A has this fund. Okay, let us give this fund. Company A will bring this fund. Let's give it to company B. You see, it's going to save the company B of going to borrow money to solve their problem. So what they do set off. That set off means taking funds, surplus fund from company A and giving it to company B to carry out their business activity. So this will result to savings in interest that would have occurred had it been the subsidiary that needs that finance obtains loan from external party. You see that? So because they are all together, they are one company, that interest is saved. That interest nobody is going to pay because it's not an external, it's inside house, right? Now we move to foreign currency risk. We are talking about advantages of centralized treasury management. Now the next one is foreign currency. This can be efficiently managed by adopting the most cost-effective hedging technique, that is netting. When you get hedging is a very interesting topic, Shao, but you need to put your head down. All right, so this is a way of managing or hedging your foreign currency risk. You say, if it is not this, we shouldn't do. If it is this, we should just be at this position. Then we have transfer pricing. Transfer pricing, I think it was in PM. I don't think transfer pricing, there's no transfer pricing in SFM. You see that the knowledge you have in skills is helping you in professional. So transfer pricing can be set within the group to ensure that the group tax liability is minimized. I believe we understand this aspect. When you're selling, when you're moving products from one group to the other, or one department to the other, you know that the price, there will be no extra cost, right? Now let's say if you're selling it outside the company, maybe you could package, you could transport it. But if you're moving it from department to department, you just call that guy, come and carry this thing. You know, all of those things. You just move it in your system, just system movement, right? And then it helps to also reduce group tax liability for multinationals, that there is this transfer pricing regulation for them that they normally carry out every year. Right, and the penalty is very high when that compliance is not done. The penalty is very high compared to what we do. Then we have profit center. The Treasury Department can operate as a profit center to generate extra profit for the group. Now, a Treasury Department can operate as a profit center when it does more than simply manage cash. What does this mean? Instead, it actively uses the company financial resources to generate income and reduce financing costs, with its performance measured by the profit or the value it's created. Now, the Treasury Department operating as a profit center means that they are not just managing their cash now, right? They are not just holding money. They are using that finance, that funds in the company to generate income. They are investing it to generate more money for the organization. So it now becomes what? Profit center. They are not just there, let's just keep the money. Any day we need money, we'll bring. But they are thinking, they are being creative. What business will we invest in order to make more money or generate income for the organization? So we move to the finance experts. The services of experts in finance will be enjoyed. These are experts that have knowledge of swaps, futures, all these things. You see them in hedging. You have swaps, you have futures, then options, and other financial derivatives and instruments. So when you talk about the treasury management, the centralized system, it needs an expert. It needs an expert who is very much knowledgeable in financial instruments, very much knowledgeable in hedging, and all of that. Because if the person is not an expert, the person may not, know how to apply this knowledge. And if the company wants to look for external bodies to apply this knowledge, it's going to cost them a lot of money. So these are the advantages of having a centralized treasury management. Okay, so I think we should just treat, our time is almost up. Let's treat the disadvantage, then in our next class, we can continue. So we have disadvantages of centralized treasury management. Now, remember I said that what has advantage has disadvantage. Now, this treasury centralized has bulk investment and borrowing. It has set-off. It has foreign currency risk management and all of that. And then for disadvantage, There's dependence on central team. Now, the local branches now, we now depend heavily on the central, right? And it could bring a form of delay. It could bring a form of delay, because if the central has not, brought funding, has not brought decision for us to carry out, nothing needs to be done. A form of delay. So there is dependency on the central team. Now, it could also reduce flexibility. The local units may not be able to respond quickly to their specific financial needs, because decisions must come from the central. They cannot make decisions. They cannot respond quickly. Imagine your supplier says, we have a product now, and by next week, there'll be a hike in price. You need to buy it and keep. And then you don't have funds with you. You are now calling on the Treasury Department. We need to buy a product. The Treasury Department will not just carry money and give to you. There are processes, right? There are documentations that need to be carried out before that money is released to the organization. So it's going to reduce flexibility. Maybe before all those processes are being carried out, the company that has the goods is no longer available. The goods are no longer available, and you have lost that opportunity. So it reduces flexibility. It increases bureaucracy. Centralization can create more approval processes and procedures. You need this person, this department to sign, this one to sign, that one to sign, attach document before you pass through. And maybe the people that are meant to sign those documents may not even be around. Maybe this one is not around to sign. You now send a mail. Please, sir, see attached file for your kind attention. The person you're sending mail to may not be actively online, or maybe in a meeting. You see that? So there's a kind of slowdown in the decision making, in the processes involved. It's just like an organization that you want to sell. You want to sell. So before you sell, when you raise your sales order, you need the other team to check it and see if the inventory house or whatever, they need to check, do we have these things before we proceed to raising invoice. These are processes you must wait. Then the customer makes payment. You must wait for accounts to confirm that they have paid before you go and sell. Because if you go and sell, the payment was not made, you will be the one to bear the consequences. So it increases bureaucracy. It slows down processes and procedures. So this, which may slow down transactions and decision making. And then lastly, we have limited local knowledge. The central treasury may not fully understand the local markets. Now, let's assume the treasury management is centralized in Lagos. And then their subsidiary is situated somewhere in Abia State, right? Now, them that are in Lagos may not fully understand the local markets, what is happening in Abia State. They may not truly understand that the traders in Abia State, this is the kind of thing they do, this is the way they operate. They don't have patience. They don't have patience. They will not understand, they don't understand their banking environment. It could be that in the area that company is situated, you just have one bank, and then that place, market women, traders, everybody is always going to that place. The place is always crowded. Unlike in Lagos, where you can see numerous branches of a particular bank. If you don't want to go here, you go here, right? Then the regulations surrounding those businesses in Abia State is different from the regulations in Lagos State. So the centralized treasurer will be limited in the local knowledge, right? It will not be able to say this is what is obtainable here, this is what is obtainable here. That is why they also need the input of those in that place. So these are the disadvantages of centralized treasury management. Number one, don't forget, is dependent on a central team. Everybody has to depend heavily on the central treasury for funding and all of that. It reduces flexibility before decisions are taken. It's kind of delayed. There may not be quick response to a specific a financial need. Imagine they want to collect money from another group and give it. They will have to make contact. Their processes, their documentation, the money cannot just come. They will document. So those things are processes that reduce flexibility. There's increase of bureaucracy, and there's limited local knowledge. I think we should draw the curtain here for today, and then we'll continue in our next class. Please, does anyone have anything to say or any question to ask? You can do that.
Hello, good morning.
Good morning, sir.
Thank you for this lecture. So my question is, where we talk about the way of measuring the financial objective of an organization, whereby we talk about using profitability ratio.
Okay.
Yeah, my question now is that, well, when we carry out this profitability ratio, at times the profitability ratio maybe look nice, but for this purpose of this uh, course, we talk about strategic financial management. The purpose of carry out this ratio is um, to make a strategic decision for the organization as a whole. So when we carry out this ratio analysis, but at the end of the day, we didn't compare it with, maybe there's a benchmark or over the period of year to see the trending. Okay, in our sales last year compared to the sales this year, okay, do we have reduction? What is the gross profit margin for last year and this year, and make comparison. So at the end of the year, we can also what are the reasons why our sales revenue dropped this year, what are the reasons why it increases, for us to also sit tight. I think one of the factor to put in place is to compare the over the number of years the analysis that we did. If I'm right, I'm sorry to be corrected.
All right. Are you there, Madam Elena? Let me. Hello. All right. Can you all hear me, please?
Yes, sir.
All
Yes,
right.
sir.
Yes. Yes. As a part of the analysis of running ratio analysis, there is what we call cross-sectional analysis. There's what we call trend analysis. There's what we call industrial analysis. So when we carry out this computation of ratio analysis, we can do an historical trend, that is looking at the trends. And that is what one thing case study does. When we are asked to analyze ratio in case study, we look at the trends, because we have financial statements of like 212, 213 in that order. Then you see, looking at profitability, what is the growth? Have there been any growth? If we have growth, what are the likely causes of the growth? Is it that we have less of
So
marketing strategy? Is it that
Okay.
yes,
Sorry about that. Please, can you hear me? Can everyone hear me, please?
Yes, ma, we can hear you.
Okay. From the question, in calculating or carrying out a financial performance of organization, there is usually what to look out for, right? Now, it could be you're comparing the company with the industry standard. What does the industry say? What does people in this industry, what do they do? What do they achieve? What's the industry standard? What's the ratio in the industry that you can use to check if you are performing well or not, right? Now, aside that, you could also try to be doing comparative analysis,
right? You could be saying, let me check what we did last year and what we did this year. Then you check the ratio. We increase or we decrease. So there is always a benchmark, or there is something to use to hold on to in that analysis. Now, a company's gross profit margin could be very good, and then when you want to now come and check their net profit margin, it will drop. Now, because maybe there are expenses in between, operating expenses, administrative expenses that are very high, that brought down that beautiful gross profit margin to a low net profit margin. So even in exam condition, there are always benchmarks. Maybe they will say industry standard is it. For SFM, they normally do that. They will say industry standard is this, so that when you check, when you analyze, you'll be able to say that the company did not meet up what the industry standard says. Now, for the purpose of maybe your case study, they are just asking you to analyze what you have seen. What did you see? You say the net profit margin reduced by 10%. How? Where did you find that? How do you know it is that? You get that? Now, for an organization in practice, what we do is we try to compare, because we have set a budget. We have a budget that is working, a working budget in the organization. So we try to check how far have we gone in our budget? What have we done? What is our actual performance from our budgeted performance? So there's always a historical data to look out for when you're carrying out this performance measurements. I don't know if I've answered your question, sir.
Yeah, thank you.
You're welcome, sir.
Any other question? All right, thank you very much, Madam Inena, for that insightful section. And as I've said, that I have some questions I've put together in relation to the chapter 1 of strategic financial management. We're just going to look at one. I'll forward to her. She's going to add to the document she's going to forward to the platform. So we're just going to do an analysis of one. The question cut across various aspects of chapter 1. But let me see the one I'll be much interested in, so we can discuss and see how far we've come along with the discussion. All right, let me go with this one that is having my name. Yeah, that To Sfm Manufacturing PLC is a listed Nigerian company operating in a highly competitive industry. The board has recently reviewed the company's corporate objectives and strategic direction. The managing director believes that the company's primary objective should be to maximize annual profits. The finance director argues that the company should instead focus on shareholders' wealth maximization. The company is also facing the following issues. Shareholders want higher dividend. Managers want to retain profit to finance expansion. Employees are requesting higher salaries. Lenders are concerned about increasing debt. Government expects the company to comply with tax and environmental regulations. Customers are demanding higher product quality. The local community is concerned about pollution from the company's factory. The board is considering establishing a central treasury function and introducing a management incentive scheme linked to earning per share and share price performance. Required. Explain the meaning of strategy and identify the common features in the definition of Chandler, Drucker, Johnson Scholes, and Waddington. 6 marks. Explain strategic financial management. Distinguish it from conventional financial management. Discuss why shareholders' wealth maximization is generally regarded as the primary corporate objective of a listed company. Discuss 4 limitations of profit maximization as the primary corporate objective. Identify the stakeholders groups in the scenario and explain the nature of their interest in Top Manufacturing PLC. F. Explain 4 potential conflicts between the stakeholder groups, identify above, and explain the agency problem that may arise between the shareholders and managers of Top Manufacturing PLC. Explain 3 ways in which the proposed management incentive scheme could reduce agency problem. Explain 4 functions that could be performed by the proposed Treasury Department. Explain how the corporate social responsibility consideration could affect the company's strategy and long-term shareholders' wealth. What a lengthy question. All right, we'll just talk about 1 or 2. I'll forward it to the group. We'll forward it to the group so you can look at them and have a holistic understanding of what the question entails. If I have time, I can come up with the solutions likewise, but you can analyze them individually and see. Now, to start with, talking about the meaning of strategy and the common features in the definition of Chandler, Drucker, and Johnson, Scholes, and Worthington. I followed the class very well, and I think she actually mentioned a common thing linking the whole definition. So I want somebody to quickly respond to this question that haven't followed the class. What is the meaning of the strategy? And can we identify the common features in the definition of Chandler, Drucker, and Johnson, Scholes, and Worthington? Yes, the floor is open. So we just treat this question, then we'll close the class so that will not take your time. Some of you have other engagements. Yes, who are those in this class? Mommy Adenike, Madam Odunayo, Chidinma Umeze, Mr. Patrick.
Good morning, sir.
Hasina. Yes, sir. Let me hear you, sir.
Okay, I can say strategic is the determination of the basic long-term goals and objectives of an organization,
All right, sir.
as well as the adaptation of the course of action and the allocation of resources necessary to carry out these goals.
All right. So what are the ties? What are the common features? Hello? So what are the common features?
Maximization of shareholders' wealth.
Okay. Maximization of shareholders' wealth. So some of the common features by these authors, we have long-term orientation, that is strategy focuses on long-term direction and survival of the organization. In terms of objective, they are concerned with achieving clearly defined organization goals. And these goals will involve what? Deciding on how scarce resources of the organization should be deployed in order to achieve the overall objective of the organization. So, sorry, excuse me. So, with this concept, with all we've said, you can see that there is a tie among their definition, because they try to see and recognize the importance of responding to changes and opportunities in the business environment. So there is more to say, but because of time, I'll just hold it forth here. I'll stop here. So we'll incorporate these questions alongside the material she's going to forward to the group. And that will be all for now. We're going to continue come Thursday. Yes, Thursday. So thank you very much for your time. Let's have a blessed weekend ahead.
Thank you, Mr. Tope. Thank you, Madam Nena. God bless you.
Thank you, ma'am.
Thank you, ma'am.
I really appreciate it.